In 1923, Germany experienced one of the most extreme cases of hyperinflation in modern history, where the price of a loaf of bread doubled in a single day. The Reichsmark became virtually worthless, demonstrating how government debt and unchecked monetary expansion can devastate ordinary citizens almost overnight. By 2008, the global financial system faced another paradox. Banks deemed too big to fail leveraged trillions of dollars while taxpayers bore the consequences. The crisis revealed that the structures designed to generate private profit often externalize risk onto the public, a recurring economic pattern throughout history. Economic collapses rarely happen by accident. They follow a predictable sequence of excessive credit expansion, asset bubbles, and debt accumulation. Central banks, in their attempt to stimulate growth, often create conditions that amplify inequality and systemic risk. When governments borrow excessively to fund spending, they indirectly inflate the money supply by issuing new debt. This creates a cycle where debt begets inflation, inflation pressures currency value, and financial instability becomes inevitable. The international role of reserve currencies, such as the US dollar post-World War II, has historically allowed governments to borrow far beyond their domestic capacity. However, this privilege also encourages excessive leverage and reduces the immediate market discipline that would normally constrain fiscal policy. In 1997, the Asian financial crisis began in Thailand when the baht collapsed after speculative attacks and excessive short-term foreign borrowing. Within months, Indonesia, South Korea, and Malaysia faced severe currency devaluations, soaring debt burdens, and collapsing banking systems. Thailand's central bank had maintained an overvalued currency to attract foreign investment, while banks extended credit recklessly to unprofitable projects. When capital flows reversed, the resulting debt shock forced governments to implement austerity and seek IMF bailouts that deepened public hardship. During the 1980s Latin American debt crisis, countries like Mexico and Brazil borrowed heavily from international banks at floating interest rates. Rising U.S. interest rates and falling commodity prices triggered defaults that wiped out billions in savings and halted economic growth across the continent. The collapse of Argentina in 2001 mirrors these patterns, with the peso pegged to the U.S. dollar and mounting sovereign debt. When confidence eroded, the government defaulted on $95 billion in bonds. The banking system froze, and inflation surged to 40% in the following year. The recurring mechanism is clear. Debt accumulation, over-leveraged financial institutions, and inflexible currency systems set the stage for economic collapse. Policymakers often respond reactively rather than proactively, which exacerbates systemic vulnerabilities. Today, U.S. federal debt exceeds $33 trillion, with the national deficit running above $1.5 trillion annually. This mirrors historical patterns where excessive borrowing eventually pressures interest rates, reduces fiscal flexibility, and concentrates risk in the financial system. Global central banks hold over $20 trillion in combined assets, an unprecedented expansion designed to maintain market stability. While intended to prevent crises, these interventions have created record asset valuations and growing wealth inequality. Inflationary pressures in 2022-2023, driven by post-pandemic stimulus and supply chain disruptions, exposed the fragility of highly leveraged economies. Governments face the same dilemma as in the past. Raising interest rates risks recession, while maintaining low rates fuels long-term instability. Modern banking systems remain heavily interconnected, meaning a single, large-scale default could cascade globally. Credit derivatives, shadow banking, and repo markets amplify these risks, echoing the same vulnerabilities seen in 2008. Emerging markets today carry record levels of dollar-denominated debt, making them susceptible to currency shocks. As the U.S. dollar strengthens, these nations face repayment pressures that mirror historical crises like the Asian financial crisis. Central bank digital currencies and unconventional monetary tools, while innovative, introduce new layers of systemic complexity. The long-term consequences of these tools on inflation, debt sustainability, and financial stability remain largely untested. If current debt trajectories continue, governments will face mounting interest obligations, leaving less room for public investment in social programs. Historical patterns suggest that prolonged fiscal stress often precedes inflation spikes, currency devaluations, or sovereign defaults. Banking crises are likely to recur in environments of low regulation and high leverage. Without structural reform, the collapse of overextended institutions can destabilize economies, reduce public trust, and erode savings. Global trade imbalances, combined with reserve currency pressures, create conditions for synchronized economic shocks. When multiple countries experience debt stress simultaneously, contagion effects magnify financial and social disruption. Investors and policymakers must recognize that short-term interventions rarely solve long-term structural issues. As history demonstrates, the economy often self-corrects in disruptive, painful ways rather than gradual, orderly adjustments. The Great Depression of 1929 offers one of the clearest examples of systemic banking collapse. Excessive stock market speculation and poorly regulated banks created a fragile financial structure that imploded when asset prices fell. Between 1929 and 1933, the U.S. banking system lost over 9,000 institutions, wiping out the savings of millions. Unemployment surged to 25%, and industrial production fell by nearly 50%, illustrating the human cost of financial mismanagement. Germany's 1923 hyperinflation also shows the social consequences of monetary policy failures. Workers' wages could not keep up with rapidly rising prices, forcing families to barter or carry cash in wheelbarrows. The role of central banks in these crises is crucial. The Reichsbank printed money to finance reparations and government debt. This intervention stabilized political goals, but destroyed domestic purchasing power and public trust in currency. In Japan during the 1990s, the asset price bubble burst after years of excessive lending and speculative real estate investments. The government and central bank responded with prolonged low interest rates, creating a lost decade of stagnant growth and mounting public debt. The 2008 global financial crisis provides a modern illustration of similar mechanisms at work. Mortgage-backed securities, opaque derivatives, and high leverage allowed risk to accumulate unseen until the system nearly collapsed. Lehman Brothers' bankruptcy in September 2008 triggered panic in interbank lending markets. The failure demonstrated that systemic risk in highly interconnected financial institutions could overwhelm national governments. European sovereign debt crises, especially in Greece, Italy, and Spain between 2010 and 2012, highlight debt sustainability issues in a shared currency union. High public debt and structural deficits forced austerity measures that slowed recovery and triggered social unrest. Greece's debt-to-GDP ratio exceeded 170% by 2011, while unemployment approached 25%. IMF-led bailouts imposed strict fiscal discipline, but failed to restore sustainable growth quickly. These historical examples illustrate a common framework: excessive borrowing, poor regulation, and inflexible monetary systems. Once the feedback loop of debt and inflation starts, even minor shocks can trigger catastrophic outcomes. China's credit expansion over the past 2 decades has fueled rapid GDP growth, but also created significant debt risk. Local government financing vehicles and corporate debt now exceed $40 trillion, raising concerns about potential defaults and contagion. The rise of shadow banking globally complicates risk assessment, as large pools of credit operate outside traditional regulatory oversight. This echoes historical financial blind spots that amplified crises in the past. Cryptocurrency markets introduce a new form of speculative finance, with billions of dollars in volatile digital assets. While not yet systemic, extreme price swings and leverage have already triggered failures that mimic traditional banking crises. Central banks today face the dual challenge of stimulating economies while preventing asset bubbles. Low interest rates and quantitative easing fuel investment, but also risk long-term inflation and wealth concentration. In emerging markets, debt denominated in foreign currencies exposes governments to exchange rate shocks. Depreciation of local currencies can sharply increase repayment costs, replicating patterns from Latin America and Asia. Global supply chain disruptions and energy price shocks in 2022-2023 further stress debt-laden economies. Countries with high import bills and external borrowing face elevated default risk. If these patterns persist, the world may face synchronized debt crises in both developed and emerging markets. Historically, simultaneous defaults exacerbate market panic and limit central banks' ability to intervene effectively. Rising public debt can constrain future fiscal policy, forcing governments to cut spending or raise taxes during economic downturns. This mirrors the post-World War I reparations scenario in Europe, where austerity deepens social and economic instability. Banking crises are likely to recur in environments of low regulation and high leverage. Without structural reform, the collapse of overextended institutions can destabilize economies, reduce public trust, and erode savings. Global trade imbalances, combined with reserve currency pressures, create conditions for synchronized economic shocks. When multiple countries experience debt stress simultaneously, contagion effects magnify financial and social disruption. Households and businesses face reduced access to credit, higher loan costs, and declining real wages during crises. Patterns from historical collapses show that ordinary citizens bear the brunt of financial mismanagement long before policymakers face consequences. The Weimar Republic's hyperinflation also demonstrates how political instability amplifies financial crises. Rapid currency depreciation eroded savings and fueled social unrest, paving the way for radical political change. In 1971, President Nixon ended the Bretton Woods gold standard, disconnecting the US dollar from gold. This allowed unrestricted monetary expansion, but also introduced long-term inflationary pressures that persist today. Japan's 1990s banking crisis shows the danger of prolonged credit bubbles. Non-performing loans remained on balance sheets, preventing banks from lending effectively and stalling economic recovery. During the 2000s housing boom in the United States, mortgage credit expanded rapidly to subprime borrowers. When defaults surged, the resulting losses triggered a collapse of major financial institutions and nearly toppled the global banking system. The European sovereign debt crisis highlighted the danger of debt accumulation without fiscal sovereignty. Countries in the Eurozone could not devalue currency to manage debt, resulting in prolonged recessions and austerity measures. Global debt has reached record levels, surpassing $300 trillion when combining public, corporate, and household obligations. Such extraordinary leverage creates systemic fragility reminiscent of previous debt-fueled collapses. Central banks' unconventional policies, like quantitative easing, have inflated asset prices far above historical averages. While intended to stabilize economies, they exacerbate wealth inequality and potential market distortions. Emerging market debt denominated in US dollars has surged, exposing governments to interest rate hikes abroad. When the dollar strengthens, repayment burdens increase sharply, mirroring patterns from the Asian financial crisis. The 2020 COVID-19 pandemic triggered unprecedented fiscal stimulus and monetary expansion. While it prevented immediate collapse, it also accelerated debt accumulation and asset inflation globally. Corporate debt levels in developed economies have climbed to historical highs. This leverage increases vulnerability to interest rate shocks and slows recovery if growth falters. Rising interest obligations on government debt will limit spending on infrastructure, education, and healthcare. History shows that such constraints often deepen economic inequality and reduce social mobility. Financial crises often emerge after long periods of apparent stability, catching markets and policymakers off guard. This calm before the storm dynamic repeats across decades, from the 1920s to 2008. Credit expansion, if unchecked, inevitably leads to asset bubbles. When these bubbles burst, the resulting economic contraction disproportionately affects lower income populations. Banking regulation plays a critical role in preventing systemic risk. Yet history shows cycles of deregulation often precede crises. From the 1980s savings and loan collapse to the 2008 financial meltdown, weak oversight magnifies risk exposure. Global reserve currency dynamics influence debt sustainability, as countries borrowing in foreign currency face higher default risk. Historical episodes, such as Argentina in 2001, highlight the dangers of rigid currency pegs and external debt reliance. Rising inflation erodes purchasing power, especially among fixed income earners. The consequence is a widening gap between asset owners and the general population, reinforcing patterns observed throughout economic history. Modern financial instruments like derivatives and complex debt products create hidden risk exposure. Failure in these markets can trigger sudden liquidity crises that spread rapidly across borders. Currency volatility remains a persistent risk for debt-laden economies. Historical examples show that exchange rate shocks can precipitate banking crises and government defaults simultaneously. Global interconnectedness means that crises rarely remain localized. Contagion effects spread from one market to another, escalating local financial shocks into systemic global events. Household financial vulnerability mirrors the macroeconomic patterns of debt crises. Rising personal debt, declining wages, and inflation pressures leave millions exposed when systemic shocks occur. The 1980s Latin American debt crisis illustrates the dangers of borrowing in foreign currencies without sustainable revenue. Mexico, Brazil, and Argentina faced soaring interest rates and collapsed exports, triggering widespread defaults. Rising U.S. interest rates in 1981 intensified the debt burden for these nations. Creditors demanded repayment, forcing governments to implement austerity policies that deepened social and economic hardship. During the 1994 Mexican peso crisis, rapid capital flight exposed the fragility of short-term foreign borrowing. Within weeks, the peso lost nearly half its value, and the government had to request an emergency $50 billion bailout from the U.S. and IMF. Russia's 1998 default demonstrates the volatility of emerging market debt under systemic stress. Ruble devaluation and government default led to severe banking collapses and contagion across global markets. These examples highlight a recurring chain: excessive borrowing, currency rigidity, investor panic, and institutional collapse. Patterns repeat because financial systems often rely on short-term confidence rather than structural stability. Corporate leverage in the U.S. reached over $11 trillion by 2023, exceeding pre-2008 levels. Highly indebted companies face similar vulnerabilities if interest rates rise or economic growth slows. Government debt in Japan exceeds 250% of GDP, one of the highest in modern history. Despite low interest rates, future demographic pressures threaten fiscal sustainability and economic resilience. European nations continue to grapple with high debt-to-GDP ratios and aging populations. These structural challenges limit fiscal flexibility and increase sensitivity to global shocks. China's real estate sector, exemplified by the collapse of Evergrande, reflects the dangers of overleverage and speculative growth. When major developers fail, ripple effects threaten banking stability and regional economies. Shadow banking and private credit markets operate largely outside regulatory oversight. This hidden risk mirrors historical blind spots that intensified crises in previous decades. Inflationary pressures are likely to remain elevated globally due to high public and private debt. Historical evidence suggests sustained inflation can erode savings and amplify inequality. Rising interest rates to combat inflation can simultaneously trigger debt defaults. This delicate balance has historically led to policy errors and unintended economic contractions. Banking system fragility can create rapid credit freezes, impacting households and businesses alike. History demonstrates that systemic crises often begin with seemingly minor institutional failures. Global trade imbalances exacerbate debt vulnerabilities by creating dependency on foreign capital. When global confidence falters, capital withdrawal can trigger currency crises and sovereign distress. Housing markets remain particularly sensitive to interest rate changes and credit expansion. Historical collapses, from Japan to the US, show the cascading effects of real estate bubbles on the broader economy. Central banks face a narrowing range of policy tools as debt levels rise. Prolonged intervention risks, creating long-term distortions without addressing underlying structural weaknesses. Financial innovation often precedes crises, introducing untested instruments that amplify risk. Derivatives, collateralized debt obligations, and other complex assets can mask exposure until markets suddenly reprioritize risk. Currency volatility remains a persistent risk for debt-laden economies. Historical examples show that exchange rate shocks can precipitate banking crises and government defaults simultaneously. Global economic interdependence means crises are rarely confined geographically. Contagion effects spread from one market to another, escalating local financial shocks into systemic global events. Household financial vulnerability mirrors the macroeconomic patterns of debt crises. Rising personal debt, declining wages, and inflation pressures leave millions exposed when systemic shocks occur. The collapse of the Soviet Union in 1991 illustrates how systemic economic mismanagement can lead to political upheaval. Chronic fiscal deficits, unproductive state enterprises, and uncontrolled inflation eroded public trust and destabilized the economy. In Zimbabwe during the 2000s, excessive government borrowing and money printing caused hyperinflation that reached 79.6% billion in 2008. Citizens relied on barter and foreign currencies, highlighting the catastrophic impact of monetary mismanagement. These examples demonstrate a consistent pattern. Debt accumulation, monetary expansion, and currency instability undermine economic foundations. Historical crises rarely arise from isolated causes, but from interconnected systemic failures. Digital currencies, stablecoins, and fintech innovations introduce new forms of credit and leverage. While promising efficiency, they may amplify systemic risk if unregulated and widely adopted without safeguards. Global pension funds and sovereign wealth funds are increasingly exposed to volatile markets. Losses in these sectors could trigger broader financial strain, echoing the institutional vulnerabilities of past crises. U.S. corporate debt and leveraged loans continue to expand, raising concerns over repayment capacity in a rising interest rate environment. Historical patterns suggest that high leverage increases sensitivity to economic shocks. Global supply chain fragility and geopolitical tensions compound debt and liquidity pressures. Any prolonged disruption can amplify financial instability across interconnected economies. If current trends continue, sovereign debt crises may increase in frequency and severity. History demonstrates that prolonged imbalances rarely resolve without painful economic adjustments. Banking crises, currency devaluations, and inflationary shocks will disproportionately impact households and small businesses. Ordinary citizens often bear the immediate burden of financial mismanagement. Emerging markets with high dollar-denominated debt face heightened default risk. Currency depreciation and capital flight mirror patterns from previous global debt crises. Prolonged low interest rate environments encourage speculative borrowing. While stimulating short-term growth, this behavior increases long-term vulnerability to sudden market corrections. Financial crises often begin unnoticed in opaque markets. Derivatives, complex lending, and shadow banking conceal risk until systemic pressures become overwhelming. Global economic interdependence means crises are rarely confined geographically. Capital flows, trade dependencies, and financial networks transmit shocks rapidly across borders. Economic collapses follow predictable patterns that repeat across history, yet policymakers and the public often treat each as unprecedented. Recognizing these patterns allows for better preparation and understanding of systemic vulnerabilities. History demonstrates that debt, credit expansion, and monetary mismanagement are not anomalies, but recurring features of modern economies. Citizens and investors benefit by understanding these dynamics rather than assuming stability is permanent. Wealth concentration and financial risk are structurally linked through systemic incentives in banking and government. The economy is designed to protect capital accumulation while exposing ordinary participants to cyclical instability. Inflation, currency stress, and banking crises will continue to manifest if current economic structures persist. Recognizing the inevitability of these cycles reframes how we interpret financial headlines and policy decisions. The lesson from history is clear. Financial crises are not failures of isolated institutions, but of systemic design. Understanding these mechanisms offers insight into why ordinary people repeatedly experience financial vulnerability. While governments and central banks intervene to stabilize markets, such measures often defer consequences rather than prevent them. Citizens should critically assess both fiscal and monetary policies in light of historical patterns.